So on July 28th, I recorded a video answering the question, should investors buy SuperMicro computer stock before the company announces earnings? And in that video, I said no, that you shouldn't buy the stock, that it was overvalued and there was significant risks to the downside. Fast forward to today, the company announced their earnings yesterday after the stock markets closed, and the stock price is down over 18% as of this recording, following the company's earnings release. So I hope you watched that video and I hope you took notice to that recommendation and saved yourself some money on Supermicro computer stock. In this video, I'll review the company's latest figures and share with you my updated discounted cash flow valuation, which calculates a fair value for the business, and then answer again if I think this stock is now a buy following this 18% decline, if investors should buy this stock on the dip. So let's take a look. I want to thank The Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. So for the fourth quarter, Supermicro reported 4.6 billion in Q3 2025, 5.4 billion in Q4 2024. So the company increased revenue by just 400 million year over year. That's less than a 10% increase in revenue for a company that a few quarters ago was growing revenue by 100%, by 200%. So revenue growth has significantly slowed down for Supermicro for several reasons. Most notably, the impacts of tariffs and the slowdown in spending from their customers as a result of the uncertainties from tariffs. And then secondly, the company has changed the way it's recognizing revenue, undoubtedly because they got in trouble and they were put on notice as a result of some aggressive accounting tactics, and they were blamed for not being transparent with their auditor. And so I think management team has taken a more conservative note here in determining how to recognize revenue moving forward. Furthermore, gross profit margins declined to 9.5% compared to 10.2% in the same quarter last year. And I've been following this company for several years now, and I highlighted that this is not a high margin business. And even its competitors, Dell and Hewlett Packard Enterprises, they don't generate high margins. So this isn't a high margin business. It never was. I don't think it ever will be. And Supermicro Computer for a few quarters were growing revenue significantly quickly, and that revenue growth rate has even slowed down. As I've also been talking about with Supermicro, the cash flow had been in a unique situation where it was very, very negative. Even though the company was generating revenue growth of 200%, its cash flow would be really negative. And a lot of investors would ask me, what's going on there? Why is the cash flow negative? And should we be concerned about that? And I said that you shouldn't be concerned. And I explained, and I'll explain again, that when you're operating a hardware business like Supermicro is operating, they have to pay for inventory first because they don't have that negotiating power with their suppliers. So they have to pay for inventory up front. Then they sell their products to other companies that do have negotiating power against Supermicro. So they ask for terms like, let us pay you back in 60 or 90 days or 120 days instead of paying you right away. And so there's a mismatch between when Supermicro pays for inventory and when Supermicro gets the cash from the customers it sells to. And that problem is worsened the more its revenue is increasing because the backlog of accounts receivable is increasing while the payments are still not coming due. And that's the situation Supermicro found itself in when its revenue were growing so significantly. But now that its revenue growth has slowed, the cash flow problem has also improved, as I forecasted it would. So overall, the company still generated solid growth for fiscal year 2025, which ended on June 30th for the company. They generated $22 billion in sales for the year, compared to $15 billion for the fiscal year that ended June 30th, 2024. The growth rate was 47%. a significant slowdown from the previous year and a significant slowdown from what investors were expecting from this company for the fiscal year. Looking ahead, management is forecasting revenue between $6 to $7 billion for the first quarter of fiscal year 2026. For the full year in 2026, the company expects net sales of at least 33 billion. And if you look at the revenue growth of 22 billion, if they do indeed increase revenue to 33 billion, that would be an increase of 50% year over year. So if they hit this midpoint of the target, that would be an acceleration of the growth rate from 2025 to 2026, albeit a slight acceleration, but it still would be an acceleration, which would be good news for SuperMicro stock investors. So as I mentioned, I downgraded the stock on July 28th, and I warned investors that there was significant downside in the upcoming earnings release, and I told investors not to buy the stock before the company announced earnings. Now, following the earnings release and the lowered stock price, the intrinsic value per share, or what I feel is a fair value for this stock, is $49. The current market price is about $47, $46.75 to be precise. So I would say this looks like it's fairly valued according to my proprietary discounted cash flow valuation you're looking at on screen. But I also like to look at valuation on another perspective, and I like to go to fiscal.ai, which is my preferred data source for charts like these and financial analysis metrics like these. And when I recovered the forward price to earnings ratio, is trading at a forward PE of 25, which in my opinion is overvalued for a business with this level of growth at these kinds of margins, right? Very small margins. A gross profit margin of 10% leaves an even smaller area for operating profit margins, and these margins are declining for SuperMicro. Additionally, the stock is now trading at a forward price to earnings of 25, which is about double the valuation the stock was trading for before the AI boom created a surge in its revenue. And while I do agree that it deserves to trade at a higher valuation compared to before the AI boom, I don't think it should be trading at double the valuation from before the AI boom. Additionally, when I'm looking at a company with financial reporting risks, which SuperMicro clearly has, they've been dinged for providing misstatements on financial reports twice now in the previous 6 or 7 years. And so I place a greater risk with their financial statements because I'm not sure that they're being fully transparent. I'm not sure that they're being fully accurate. I don't know where the mistakes could be, whether it's in revenue recognition or profits or costs or whatever it might be. I allow for a greater margin of safety when I'm working with a company that has these financial reporting risks. Now, I'm still okay investing with a company like that, but I just need a much larger margin of safety there to attract my capital when I'm concerned with the way you're reporting your financial statements, which I am concerned with SuperMicro. So at a forward PE of 25 and a market price where it is today, I don't think this stock is worth the risk. And so I will update my recommendation here for SuperMicro stock and let everyone know that I don't think it's a buy on this dip here. Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.